Hello everyone. We are going to discuss about financial management, and the topic is capital structure theories, meaning and significance. Uh, First of all, we are going to discuss about capital structure. The firm has to maintain in a proper mix of all these type of securities in such a manner that both the cost and risk are minimum. The mix on proportion of different security used by the firm is called capital structure. The next thing we are going to discuss about capitalization. The financial requirement of the business organization are met through different sources of finance such as equity share, preference share, debenture, bonds, loans, etc. Sum total of all of these funds used in the firm is called capitalization, which means that capitalization includes the collection of marketable securities such as equity share, preference share, debenture, bond, loans to construct a capital structure. Next thing we are going to discuss about the major objectives of capital structure. It aims at maximization of shareholders' wealth. It should be designed in such a way that it reduces cost of capital. It should be flexible. A sound capital structure should be taken into consideration. Next thing we are going to discuss about the general assumptions of capital structure theories. The following assumptions are relevant for all capital structure theories. First one is there are only two sources of funds for the firm, debt and equity. Second is the degree of leverage can be changed by raising or redeeming debt uh, redeeming debt or by issuing equity shares. Third one is investors have the same perception about the expected future operating earnings of the firm. Fourth one is the firm has a policy of paying 100% dividends. Fifth point is the operating earnings of the firm are not expected to grow. Sixth point, the business risk is assumed to be constant and independent of capital structure and financial risk. The last point is corporate and personal income tax do not exist. This assumption was removed later in 1990s. Then next thing we are going to discuss about the theories of capital structure. A company can frame its capital structure in different ways. Consider the external internal factors. The company can adopt the following for its capital composition. The company can go for equity shares only in the first case. The second case, they can go for equity shares as well as preference shares, and then uh, uh, the next case is they can go for equity shares and debentures, and also they can go for equity shares, preference shares and debentures. The main purpose of capital structure is to increase the wealth of the company or the value of the firm. The important theories are as follows. First of all, we are going to discuss about net income approach. In net income approach, the debt increases, so as the cost of capital decreases. Then it will increase the value of firm. The equation for calculating value of firm is S plus D. S is earnings available to equity shareholders by equity capitalization rate into 100. Overall cost of capital can be ascertained by interest earnings before interest and tax by value of the firm. The next theory we are going to discuss is net operating income approach. According to net operating income approach, the value of the firm is not affected by the change in debt. It states that the value of the firm is depend upon operating income and business associated risk. Value of the firm can be calculated by earnings before interest and tax by overall cost of capital. And the overall cost of capital can be calculated by interest before earnings, earnings before interest and tax by minus interest divided by value of the firm minus debenture. In this case, no point of counting the debenture. The next theory we are going to discuss about traditional theory. According to traditional theory, the traditional theory of capital structure states that when the weighted average cost of capital is minimized and the market value of the asset is maximized, an optimal structure of capital exists. Traditional theory mainly says that a firm value increases to a certain level of debt capital after it would remain constant, then it would fall down due to borrowings. This theory states that a blend of equity and debt can lead the firm's optimal capital structure. The last theory is Modigliani-Miller theory. This theory states that the company's capital structure is not a factor in its value. This theorem states that the value depends upon the present value and future earnings. The equation is same as the netting approach theory, and that's all. Thank you.